Why in the world is liquidity a key to your success in the market as a trader and as an investor? Well, first, let's discover what liquidity actually is. Liquidity describes the degree to which an asset or security, in our case a security, can be quickly bought or sold in the marketplace at a price reflecting its intrinsic value. Intrinsic, of course, means that's what it's worth. How quickly can you buy and sell it at a price that reflects its true value, not having to take a loss? If you jump into a security or an asset that is not liquid, in order to liquidate it when the market turns against you, you have to pay a premium. Think about real estate. Your house is worth $500,000. The real estate market starts to crash. You want to get rid of that house. You can't get rid of it for $500,000 quickly, can you? Now, if you reduced it to $400,000, you might lose 20% of its value, and then be able to get out. If you bought it for $200,000 2 years ago, maybe you're happy with doubling your money. But that is a hell of a large amount of loss, a premium to have to pay in order to get out of that asset. That is one reason that we only look at liquid securities to buy in the market. Now, what's a liquid security? Well, liquidity is always shown by the difference between the bid and the ask. Now, I've pulled up on screen for you just a snapshot from the day I'm recording this, showing the S&P 500 as represented by Spider SPY. That is the S&P 500. Of course, it's an index of large companies, 500 of them that make up the Standard & Poor's 500 index. And you can see the difference throughout the day is typically 1 to 2 cents. Now, this is on an asset that's almost $300 a share. That is almost as good as cash. That is pretty darn close. 2 cents out of $297.81. Now, just a quick little lesson. People always say, well, the bid and the ask, which is it that you pay and which is it that you sell? You always pay the most and you always sell for the least. Think about it. So you're going to be paying $297.83. If you're selling, you're going to be losing 2 cents. That is very, very liquid. That means that unlike jumping into some closed mutual fund where you have surrender fees, all sorts of crazy stuff that you have to do if you jump in at the wrong time, if you go into liquid securities, very liquid securities, and that typically means they have high volumes. Look at the volume, 37,300,000. So again, huge volume out there for the day. And what you want to always think of is, how can I keep myself liquid? Because if the market goes against you or even for you, if you're having to give up a large chunk of your profit because the difference between the bid and the ask is $3, well, the minute you walk in, you've lost, potentially $3 a share. And if the market goes against you, you lose even more. So again, that is a big reason liquidity is so much of the part of your success in being a trader. The less liquid an asset or security, the greater your losses if you must close your position in a rapid manner. Folks, that only makes sense. And that is the reason we focus on that and we make that bold statement. The bold statement that liquidity is a key to your success. It is. Always keep that in mind. And the quickest way to do it, check out the difference between the bid and the ask. And if it's vast, stay away. Because if the market rolls against you, you're going to get hammered. Hey, you want to know more of what we do at chartingwealth.com? Well, come join us every single day. We chart 4 ETFs that are highly liquid. That is the S&P 500 as represented by SPY. The NASDAQ 100 is represented by QQQ. 20-year bonds is represented by TLT. And of course, gold, GLD. Thank you so much, my friends. All the best to be with you. We love your comments. Subscribe to us at YouTube. And of course, be sure to sign up for our daily market review for free at chartingwealth.com.